Okay, so this session is being recorded. So in today's session, I'll show you the concept of a speed line. I don't know if you know speed line or not, but so I'll explain the speed line in uptrend and the speed lines in the downtrend. So I'll explain how they work and how you can use it to determine the support and resistance. So it works for support and resistance, and then the retracement. So when the retracements are happening, what do you expect? How far the retracement can go? So it's very important, right? So when the market is retracing against us, we need to know how far it's going. So unless otherwise we are just trading in the dark. So so retracements are very important. So now the webinar is full and people are trying to come. All right, that's okay. I'll keep on getting the pop-up. Okay, so and then after I cover the speed lines, then I will show you some charts. So I'll show you some charts of the stocks of the trade we just closed during the last 2 weeks. It's like Apple, Facebook, etc. So this is the way speed line works. So, let's assume that the market is in uptrend. So let's assume the market is in uptrend, right? So the market is in uptrend. To figure it out, there are various ways of figuring it out, the support and resistance. So this is not the only way. So this is just one method. So I'm teaching you one method, showing you one method. So there's a Fibonacci retracement, percentage retracement, trend lines, channels, candlestick patterns, and Bollinger Band, and so many. So there are various techniques. So it's up to you which one you prefer and which one you use. You can use one or two or three or all. So this is one of the method of figuring it out, the support and resistance. So let's assume this market is an uptrend. So we can see the market is moving from 0.1 and then came down and moved up, then came down and moved up. So we can see and the higher highs are being created, higher highs. So we know that. Next, we know that this is the starting point of an uptrend. So let's say the market was bouncing up and down, and this was a clear-cut price point from where the market has taken off. So let's assume that $50. So this is where the market took off, so 0.1. Now, this point where the dotted line started, this is the point which from where the market is at the current high. So we need to know the current high price. So this is where the market is, the close price, the high price. This is where the market is. This is where the market has started its uptrend. So what we do in the speed line, to create a speed line to figure it out, the support levels for the retracement, we drop one vertical line, straight one vertical line, from the high to the price point from where the market has started its uptrend. So if this is the current high, we drop it and take it all the way down from where the current the trend has started. Once we do that, then we literally like a chalk. You can take a chalk on your screen or whatever way. You cut this vertical line into two sections, two of them. So you mark two, and not two sections, 2 points on the line to create 3 sections. So you put a line here, 1/3, and then you put another line, 1/3. So when you put one line here, 1/3, and you put one line dot here, 1/3, and then you take from point 1 and connect that dot. So you create a line, straight line over there. From here, you create another line straight all the way up. So now some bars will fall into these trend lines, some will not fall. So you're not looking for the bars to you're not creating a trend line by connecting the lows or the highs of the bars. You're not doing that. You're creating the lines by bisecting the distance traveled into three sections by cutting it into two pieces here, one, two. So now how the market works, sometime magically. So on a retracement, so if this is the today's high, so you're expecting if the market is, let's say market is coming down from the high, so you expect the pullback can happen to this upper line, and the market could stop, have a higher chance of stopping on this trend line. So this is called 2/3 speed line, and this is called 1/3 speed line. So 1/3 and 2/3. So now there are various ways of figuring it out where the market can drop and what would be my stop, where would be my re-entry, or where is the pullback level. So that's what you're trying to determine. So when the market pulls back, the market can pull back to this trend line. And another way of creating a support zone. So the support is a zone, not one price. So support is a zone. You create one horizontal line from this peak and extend it all the way here. So you're creating a horizontal line and extending it here. So there's this. So when you extend, this is the price point, and then then the price on this line. So what is expected that the market can pull back and then bounce from this speed line. So market can pull back and bounce from this speed line. So this is a called 2/3 speed line. If this market doesn't stop at this 2/3 speed line, then it's likely chances are that now the market will drop to the 1/3 speed line. So once the 2/3 speed line is broken, the high chances that the market will drop to 1/3 speed line. So whatever is your strategy, when the market pulls back to this speed line, then if you are not in the trade, you have to look for the trade. If you're not in the trade, you have to, if you're not in the trade and you're trying to look for the entry, then you have to don't just go right away and go long when the market touches this speed line. You have to take help from the other tools you have to and expect the bounce to the upside. So you have to take some help from other tools. And if the market drops below the 2/3 line, then you're expecting that the market will come down to 1/3 speed line. And then once it's broken, then you are also drawing the horizontal line, horizontal support line. So this line, this turning point, so the market magically turn around from the previous turning point. The market has a memory. There are a lot of transactions happen in the previous transaction point. So there are a lot of buyers and sellers. They fought like a battle. So they fought a battle over there. So magically, when the market reaches that certain price point, give and take few points up and down, the market just reverses. So there's a likelihood chance the market will reverse from the same price point from where it reversed earlier. So if the market reverses earlier from this price point, so once it breaks this 2/3 line, once it breaks this 2/3 line, the market has a higher chance that it will, the market has a probability. This is all about the probability. So what is your probability? You're just making your ducks in a row. So you're saying, okay, now the 2/3 speed line is broken, so let's see where it stops. So you're expecting, you draw this horizontal line here, so you'll say, okay, somewhere here the market can drop, but you know the market can drop to the 1/3 speed line. So market can dwindle, like it gives you some false signal that this is the support. Market can give that false signals that it is holding this support, and then eventually drops to 1/3 line. So this is the retracement from all the way high to the 1/3 line. And now what happens? if the 1/3 line is broken, then you expect that the market will fall further and it will take out the previous support level, which is here. So don't expect that the market will come down from 1/3 and then it will just stop here. So chances are that the market has now the sentiment has changed completely and the market is going down and beyond this support. So now, so this is the speed line in an uptrend. So I'll show you the bullet points how to draw this line. So you take the high, the latest high, you take the high and you drop it vertically to the support line from where the trend has started. You drop it and then cut it into two pieces, put a chalk mark, cut it one here, put like intersect, and then draw the line. And when you're drawing the line, you're not taking the highs and the lows of the previous bars. You're not. You're just cutting it through and drawing the straight line. So the bars can lie below and above. So this turning point is right above, right at the trend line. This turning point is below the speed line. And so now once the market breaks this 230 speed line, so you remember this, once the market breaks this 230 speed line and somewhere from here, so suppose somewhere in the middle, the market is retracing upside to the upside, it will meet the resistance of this speed line and then it can fall. So market can come here somewhere and reverses. So it reverses upward. So it's going up and it looks like it's going up, but the chances are that it will bang its head somewhere on the speed line and then fall. And then when it falls to the 1/3 speed line. And then it needs to gather energy and come with the force, dwindles a little bit, and then takes off. So the first attempt after breaking the 2/3 line, it may not break to the upside. It may fail. So once it reaches the 2/3 speed line, you have to again do your technical analysis and figure it out that whether it's holding, it's able to break, or it's failing to break the 2/3 speed line, which is now acting as a resistance. Same way, when it breaks the 1/3 speed line and then bouncing back up, it may fail on the first attempt and then come down, maybe gather the energy and then break. So once it breaks, then your speed line will be somewhere here. So your resistance is here. And if the speed line is above, then this is your ultimate resistance. Okay. So now, so this is the bullet points. I wrote down the how to draw the speed line. So a speed line measures. So a speed line measures the rate of ascent or descent of a speed of a trend. So it's telling you how fast the trend is in motion. Downward vertical line is drawn towards the price point on the chart from where the upward trend has begun. So you take from where the trend line and then you connect it to the high price. And every time a new high is made, you have to draw the new speed line. So every time a new high is made, you need to draw. And so if let's say if the market just pulls back a little bit and then takes off and making a new high, so you take that high and drop the new vertical line. So this price point remains constant because this is something in the past. What is changing is the new high or new close. So what is changing is the new high and new close. So you're drawing the new line every time a new close is created. Every time a new high is made, you need to drop another line to the same price point, which is here. So this price point doesn't change. Your high and your close or high is changing. So you're drawing another line. So a trend line is then drawn from the beginning of the trend. So I told you about the 2 points. These 2 points represent 1/3 and 2/3. So 1/3 and 2/3. Each time a new high is set in an uptrend, a new set of lines must be drawn. So every day if a new trend is being established. So every day a new trend is being established. You're creating a new speed line to figure it out where the pullback can occur. So you're better prepared. So every time a new high is made, you create another line to figure it out where the the support is. Okay, so in other words, the support, so two kinds of support. One support is constant. So these turning points are constant. They are not changing. So, and the market has memory. So the market remembers these turning points. So it has memory. But then there are certain turning points which are dynamic. So dynamic support and resistance are, you can uh, figure it out through speed line. So price action and support in bullish speed line. So if an uptrend is in the process of correcting itself, the downside correction will usually stop at the higher speed line. So when the stock is in uptrend and a stock in a strong uptrend, it's fundamentally strong, is moving good like Facebook, Apple, and then you're trying to figure it out. Okay, where could be the support? So you can draw the speed line to figure it out the support. So that is where the retracement level will take place. If not, prices will drop to the lower speed line, which is 1/3. If the lower line is also broken, prices have higher probability to continue all the way to the beginning of the prior trend. So if um, so you know the 2/3 is broken, then where it's going? It's going to 1/3. If 1/3 is broken, then where it's going? It's going to the previous turning point. So that is your ultimate. So it's like giving back all the profit made or the points captured from the time the trend has started. So if the trend started from 50 and went to the 100, so market will come back to 50. So it has given back all the profit from where the trend has started. So similarly, you can draw the speed line in a downtrend. So just reverse the process. So this is the beginning of a downtrend. So point one, which remains constant. So for this technique to work, or any technique, your starting point has to be correct. So if your starting point is not correct, these techniques will give you false lines. So your starting point has to be correct. For Fibonacci, for this, for any retracements levels you're calculating. So the starting point is just 1. So this is the starting point of a downtrend. So you understand that. And this is constant. So you understand that this is constant. It's not changing. So, and this is the latest low. So this is the latest low. So you take the latest low or draw the line upward towards towards where the trend has started, the downtrend. So once you have this vertical line, you cut it into two pieces. Draw the line, like take a chalk, put it there, right here. Take another chalk line and put it here. So you have intersect, you have divided it, and then you draw the trend line here, and you draw the trend line here. You don't care if the bars of the lows and highs are matching or not matching. Whatever, the bars can be up and down. You're not drawing the trend line, which are by connecting the lows or the highs or the close or the open. So you're not doing that open, low, high, close. You're not doing that. You just drawing the line and then let the bar go up and down. So you're figuring it out. So this is just giving you an estimate. These are not 100% correct, but sometimes they do work magically. Market does stop at these speed lines and they reverse. So I have seen it many times. I see it every day. They just reverse, and the market just fails. Something about it. So you draw this line. So this is 1/3 line. So now, and this is called 2/3 line. So 1/3 line is always the line which is closer to the starting point of the trend. So if this is a downtrend, so the 1/3 line is the closest one, 2/3 line is the next one. So now your strategy, so let's say you're watching this market and you're looking for the retracement level. So it's foolish to go short on a market when the market is already moving down, and then there's no retracement happen, and then you go short, and then as soon as you go short, the market retrace on you, and then you see a drawdown, and then finally the market comes down, and it gives you a heart attack in that process, and then you are trying to average down and doing all sorts of tricks to bring the cost down because your entry was wrong. So if you're looking for short, this is the low. So you know Or let's say even you say you already have a position chart, but you want to hold on to it. So the way you can hold on is, you know, the retracement level is this. So the retracement level is to the 2/3 line. So if the market retraces, it will retrace to the 2/3 line, and it better stop at 2/3 speed line and then drop further. So if it's not stopping at 2/3 line, and then you see here on the left, and you say, okay, there is no other support, there is no other, sorry, there's no other resistance. The resistance closest one I see is here. This is where the market has pulled back and dropped. So if I this support, so this was support, so this will act as a resistance. Oh my God, this resistance is so far, but this speed line is closer. So you're taking help of a speed line is like a trend line. So you're taking help on the speed line, and you're saying, okay, the market can retrace upward and should stop at 2/3 speed line and then drop further. So the market should retrace upward and should drop further down. So if it doesn't happen, if it crosses 2/3 speed line, then you know where the market is going. So the market is approaching this 1/3 speed line, and on the way, it's like the army is moving up, and then it's facing one more enemy hiding, and the enemy is this here, the horizontal line from this. So you know, okay, market needs to cross this line, horizontal line from here, otherwise it's going to the 1/3 line, and if it crosses 1/3 line, it will take off. So depending what you're trying to do, you're trying to go long, or you're trying to go short, or you're covering your short, whatever is your strategy. So you know the process. So once you understand the process, how the market, so the market doesn't just go straight, it takes different paths. So all these paths, we need to know what the market will do, what are the different paths. And the more path you can come up with, more scenarios, multiple scenarios, the more prepared you are. So if you have only one scenario, okay, I'm short and the market is going to zero, it may not happen. Similarly for the long, it's going to the moon, no. So all the way the market is just doing zigzag. So it's like constant battle going on, and you are evaluating it and scaling in, scaling out, closing the trade, re-entering it, whatever is different thing going on whole day. So when the market goes to 2/3 speed line, it needs to stop here and then fall. So if you have a short, and if it goes to 2/3 speed line and it falls, you can add to your short. So that is another strategy. If you don't have a short position, if it bumps 2/3 speed line and then start dropping, you can initiate a new short. If you have a short position and then it crosses 2/3 speed line, you close your short and then you initiate your long position. You can do that, knowing that, okay, I initiated my long position because it crossed 2/3 speed line, but it better not drop below the 2/3 speed line. That's my stop. So you initiate a little bit when the crosses the 2/3 speed line, and then you're waiting for the market to approach 1/30 speed line. So when it goes to 1/30 speed line, you are hoping that it crosses above 1/30 speed line and doesn't fall back. So even if it falls back, it will come back to your original price where you went long. And then if it takes off, then you know, okay, now the market is gathering momentum. So what is happening with the speed line? The speed line, so again, there are dynamic support and resistance, and then there are constant support and resistance. So constant support and resistance, the market knows that those market have memory and market acts, but those constant support and resistance, they need to be recent one. They cannot be stale. So if they were stale, if you're looking for, let's say for the swing chart, if they are 2 weeks, 3 weeks, 4 weeks old, then it may not be valid, or no more than 8 months. So they can come back. Even 8 months old previous resistance and support can come back. So, but for the dynamic support and resistance, so let's say you are a day trader or trading, let's say NASDAQ future. If you're a day trader, or even if you're a swing trader, when the market is moving and you're deciding what action to take, so this is a constant resistance, but this speed lines are dynamic. They are moving. So they are moving down. As the market is moving up and down, they're moving down. So the resistance levels are coming closer and closer to your current price. So then knowing the resistance and support, which are closer to your support and your current price, you have a better understanding of the support and resistance. You can act faster, because what happened if we have a stale or the constant support and resistance, we are taking action way too late, because we are relying on this support. So we are relying on this resistance, which if it's broken, I'll go long. Whereas if you're relying on this to be valid, the speed line, then you're taking earlier action, and it may work. So try the speed line, because this is giving you a closer look, closer levels. Similarly, closer levels as a two-third. So by knowing the speed line where the market can stop or cross and gather the energy. So when any time when the market breaks the resistance or support, it should accelerate in momentum, because then the big boys also know that okay, the game is over, and all the other traders in the world, they know that okay, this resistance is broken. Now I'm switching the side from short to long, and those who are on the sideline, they also come in and they join the winning party. There's a regime change, so the regime has changed. Now there's a new leader, and the leader is along going on the long side, so you have to join that bandwagon. So taking help from the speed line is just another tool. So you can take help from the speed line and see if it works for you. So this is the speed line in a downtrend. Similarly, so I have explained, I don't have to go through these bullet points. So what you do is you drop the line from the recent, from where the market has turned the down, started the downtrend, you drop the line to the recent low, and then cut it into two pieces, and then draw the trend line. So when you draw the trend line, it will give you three sections. One is the 1/3 line, and then the 2/3 line. So when the market is retracing, it will first bump at 2/3 line. If it breaks 2/3 line, it will go to 1/3 line. If it breaks 1/3, is going and making a new high, recent high, it will take out the previous resistance. So on its journey, when the market is making its journey, whether up or down, you have to come up with your battle plan. So every day you have to come up with the battle plan, that this is the scenario, this is what happened, this is the low, this is the high, this is a happened turning point, and this is my speed line, and I have this plan. So all this you need to go through the mental plans. I teach this in my 6-day duplicating success course, which is only 6-day session. So I teach the scenario planning in that course. So if you are interested, send us email. It's called Mastering the Market, Duplicating Success. All right. So now, price action and resistance in bearish speed line. If a downtrend is in the process of correcting itself, the upward correction will usually stop at the lower speed line. So the lower speed line is the first line from the low. If not, prices will continue to retrace to the higher speed line, which is 1/3 line. So if 2/3 line is broken, it will go to 1/3 line. And if the 1/3 line is also broken, then it's a clear-cut signal that you have to look for the new high. That turning point is over. So this is over. If you are short and then you're waiting somewhere, or you shorted here and you're waiting for this price to, then eventually you will end up losing, because you shorted somewhere here. So you will end up losing. And then what happens when we lose? When we lose, we get like a mental shock. And even though we see clearly the market is in uptrend, we don't go long. We just sit on the sideline. Market doesn't care if you're sitting on the sideline. Market will do whatever it has to do. So by having a plan, you are prepared mentally to take your losses, so or cover your short and take the profit. Sometimes we just, if we see $2,000 profit and then we see $1,000, so now $1,000 profit looks bad, and then when it goes to $500 profit, then it looks really bad, and then zero break even is no, cannot. We need $2,000, and then we see $2,000 loss, and then $5,000 loss, and it just keeps going. So knowing this and preparing mentally where to cut it, where to cover your short, and where to initiate long position, because as soon as you cover your short, you have a reason. So why did you cover your short? Did you cover your short because your profit objective met? even though the market is moving down, but you covered it because you don't feel good. You say, okay, I'm happy with it, or it's Friday, or I have to go on vacation, whatever is the reason. So if whatever is the reason you covered your short, you're happy. So maybe you covered your short because you were fearful. So that is really bad. You we shouldn't be covering our trade because we are fearful. If we are, then we may be not trading short side, or maybe we are overexposed. And if the market has given you technical reason to cover it, that's the best reason. The technical reason gave you, and you cover your short. Now you don't have to go long immediately. Just because you covered your short, it doesn't mean it's a long. It may go on a sideway, or it may just take a breather and then start a new short. So once you cover your short, you take a back step, and then you reevaluate the situation, and then you get ready and go on a stalking mode and go into the monitoring mode, and then you take the long position if it's telling you that the market has set up for long. If not, maybe the market is giving you another short entry, and then you go another short and kill another time. So all this goes into mental scenario and rehearsal. So being ready. So imagine Navy SEALs or the pilot who go in the sky, F-16, F-20, they just don't go there without any planning. So otherwise they get shut down. So now reversing role. Yeah, so reversing role. So I explained to you already the speed line reverse role. So speed line reverse role. So the speed line which was acting as a support, once it's broken, it will become resistance. And the speed line which were acting as a resistance, once it's broken, it will become as a support. So this is, so once again, once the upward speed line 2/3 is broken, and the market comes down somewhere here, and it is trying to regain its momentum and approaching the 2/3 speed line, the chances are that this speed line will act as a resistance line, and the market will bump and then fall down. So you have to be careful, especially if the volume was high on the downfall. So when the market crashes, you have to evaluate the volume. When the market is coming down, you have to evaluate the volume, how the volume is. The volume was high and it just broke through. Then on the way up, the volume is less and it's just normal or below average. Then the chances are that it's just a short covering, and then the market will just bump its head somewhere here and then fall. So once the speed line is broken to the downside, it acts as a resistance. Previously it was support. Similarly, 1/3 line, which will act as a support, if it's broken, it will act as a resistance, and then the market will fall. So you have to evaluate the volume on the recovery. On the recovery, you have to evaluate the volumes. Similarly, on the downward speed line, when the market is approaching the 2/3 speed line, so if the volume was high on the way down and the market approaches this 2/3 speed line, it needs to break through with the force. So there needs to be some power for the market to come up with some speed and momentum to break through. Otherwise, it will just bump its head and fall. So that's where the volume analysis comes through in handy. So you have to evaluate the volume at that time. Whenever the market is reaching support and resistance, you have to evaluate the volume, because if you're not taking care of the volume, then you're just looking at the price, and price may deceive you. So you have to look at the volume and the price, and then figure it out what is the next action you should take, or what the market will do. So when the upper line is broken, then it means that the old highs will probably be challenged. So whenever the lines are broken, then the other levels will be challenged. So you have to know the next level, whether it's to the upside or to the downside. Internal trend lines. So what are the internal trend lines? So internal trend lines are the lines which are regular, like you draw the line by taking all the lows. So you have whatever is your strategy, either by taking the lows, or by taking the open of the prices, or whether you take the high and the close. So whatever is your strategy, you draw those internal lines. So in these speed lines are not internal speed lines. These are drawn by cutting it into pieces, by dropping a line and cutting into two pieces. So that those are these are internal lines, and let the bars decide where they stand, whether on the other side of the speed line or the this side or that side. So you don't care about where the bars are. You're just crossing it and drawing it. Okay. So the trend lines are subjective. So these internal trend lines are subjective, but the philosophy is to take as many lows, connect as many lows or open prices and draw the trend line, or by taking as many highs and close and draw the trend line. So one person can draw the trend line and take like 10 candles. Another is drawing the line and he's saying, okay, only these 8 candles. So these lines are subjective. My trend line, if 10 traders are given a chart and asked to draw the trend line, they will draw different trend lines, different wedges, different trend lines. So they're all different. But for a speed line, there is less subjectivity because you're taking the starting point. So your starting point needs to be correct. And then you're dropping the line to the high and or the low. So your speed line, the starting point is the one, and then you're just taking the high and the low. So the subjectivity goes away in the speed lines. Now, there are other ways of drawing those lines, Fibonacci lines. So if you don't know about Fibonacci, so please Google Fibonacci numbers, and there are Fibonacci degrees. So there are 2 degrees, 38 and 62. So you can draw the Fibonacci lines also based on this 38 and 62 degrees, and then come up with the support and resistance lines. So you can take help of Fibonacci line, you can take a speed line, you can take percentage retracement. There are many ways of creating support and resistance. And then the holy grail of trading is understanding support and resistance. So once you understand where the support, where is the resistance, that's where the battles goes on whole day at the support and resistance places. So if you can understand the support zone and the resistance zone, which are also called demand zone, the supply zone, so different techniques. So once you understand, evaluate properly the support and the resistance, your success in trading goes up. So that's the holy grail of trading. Fibonacci fan line is supposed to provide support during downward correction and resistance during upward retracement. So same way as the speed line, Fibonacci lines, you can draw the Fibonacci fan. So it's something called Fibonacci fan. You can draw the Fibonacci fan, and the market moves in between those fan lines. So once it crosses one fan line, then it goes above. It's literally like a fan. So the market behaves as it travels. It is bumping its head on those fan lines. So, but you have to be careful not to overdo it. So I've seen people do it overdoing it. They put a lot of moving averages. They put Fibonacci line, there's a speed line, there are trend lines, and so somewhere the market will react. And then you will say, okay, the market is reacting here, but is there a consistency? If you don't have a consistency, then your methods are not working for you, and you don't have a method of evaluating. Once the market reaches those support and resistance line, what are your methods to get the double confirmation that this is it, this is where I need to go? So are you acting boldly, courageously, or timid in a lame fashion way? Are you feeling good or bad when the market is hitting support and resistance? So if your methods are correct, you should feel very happy and some kind of excitement, but keep the excitement away, and you're bold and you say, okay, this is it, this is my chance to make money from this trade because this works all the time. So consistency. So I don't have to go through the key points I have explained to you again and again. I'll go and open another presentation, which is the charts. So I'll show you some charts. So I'll show you some chart. Just a second. Sorry, I'm shuffling around. I hope I didn't make a boo-boo. So I'm good in making boo-boos. Okay, just a second. So, okay. So do you guys see my charts? See my charts now? Okay. When do you change bearish speed line? Yeah, so the you change the speed lines when you see the clear cut turning point. So you say, okay, now the trend is over, and so you a good point. So if you know that this is a low and the market has started, then you start uh, uh, drawing the upward speed line. If the market the speed lines, um, so the downward speed lines and the uptrend speed lines. So you if you understand that okay, the market has reversed um, its direction, so you have to take the starting point and then start drawing the speed line for the upward momentum. And similarly for the downtrend. And these speed lines work in all time frames. So that's correct. You can draw the speed lines, but I use it on an hourly chart and a day chart. So uh, if we use for a lower time frame, it's just too much congestion going on. So maybe 30 minutes, and below that is just, unless I'm a scalper, I'm trying to figure it out. The support and resistance is too much. It's I don't it's overdoing it, so I don't do that. Now I'll show you some charts. We just closed yesterday. We closed Apple trade, so we had Apple trade for earning and after the earning, and now Apple is going through the split. So after the split happens, then we start trading Apple again after the split. So this was our entry at uh, different ways. So the way the things for me, the way the things work. So I'm using the other techniques, and then I'm adopting the candlesticks. So sometimes I read the hammer, the tiny candles. It tells me the story, and I take bold action. So so when I look at this Apple chart, I see this was the resistance. You see this candle. So I go through the process of evaluating the candles and then applying other techniques. So I see this candle. So I say, okay, this was the gap, and then mm, it just stopped here. And if it was the resistance, it should have come down and maybe below 420, but it did not. It started to move up. And then right here at 448, we went long, Apple calls. And then what we did, we closed at 500. So we closed Apple at 500. And why we close at 500? Because 500 is the big number. So anytime the market reaches 1,000, 2,000, 500, 5,000, these are like a big number. So I don't like to hold around these big numbers. So we closed some before even reaching 500, and all at 500. Today it went up above 500, so it's okay. There's something called overshoot. So the market have a habit of trapping people. The market traps the greedy people. So it's better that you make 126% gain than to make have a chance of making 140% gain and then losing and making only 50% gain in the hope of making 140. So which one is better for me? So for me, 126% better, which was like $3,400 per contract. So that was pretty good, right? So now Apple can do the overshoot. I receive email, oh, should I buy more at 500? It's going to 600. Maybe it's going to 600, but knowing the split, I would just, I'm not. So I close the trade, told the members to close, and now wait for the split. So if let's say the split is 4-1, if it splits happen at 125 or 130, whatever, then it will plenty of chance to time the entry on the pullback and see the run up. So it's okay. So there has to be a level where you say, okay, this is enough. So sometimes for some traders, there is nothing enough, so it's not enough. This was our BA trade. I think I showed you maybe last, I don't remember I showed you or not. This was our BA trade, and we closed on the bounce back up, on the bounce above the 50-day moving average. So if we are going long below the 50-day moving average, and if it pops up above the 50-day moving average and is giving us 112% gain, and the candle is tiny, so all this is telling us, okay, it's time to lock the profit because 112% gain. It came after 2 days. Boeing is a yo-yo kind of stock these days. There's a good news and there's a bad news, so it's just making crazy. So what are the chances that it will not make us crazy again? So it's good to have 112% gain. So locked it when it jumps above the 50-day moving average. Here is Baba. So Baba is running, these days Baba is running around a lot up. So this was our Baba entry. We went on 257. Once it closed, once it showed that this resistance is conquered. So once this resistance is conquered, what are the chances of Baba going down then going up? Because the resistance is conquered. So we went long in Baba at 257, and we closed on a tiny candle, which happened at 263.50 and at the same and the resistance level. So whenever the market reaches the resistance level, if we are holding options, it's better to close than to wait, or at least take some profit than to just let it, it's just, if there is no resistance, it's okay. But if there is a resistance there, then take 38% profit. So we took that 38% profit. This is another entry for Baba. So you see, there's after that, look how good our exit was. I didn't know that, I forgot. So this is where we exited, right? 263. So we were not greedy, because if you're greedy, didn't take the profit, this is what you saw. Baba gap down to 249 level. So when the market gaps down, so always when the market gaps down, we have to see, okay, where it's gapping down. Is it gapping down at the support level? If it's gapping down at the support level, so that's the first clue that it gapped down at the support and it stopped and it put on a tiny candle. So maybe the sellers are, all the sellers were on this gap down day. You see the huge volume. So all the sellers are on the huge, this red candle is telling us maybe the sellers were all gone. Now the buyers are in. So it's just a game. So now the buyer's game started. So went long 249 and then closed very next day 254. Now it's Baba is really running up. So we missed some big profit, but we locked another back-to-back 28% gain. Here's Burlington. So the retailers were going up. So we said, okay, retailers going up. This candle, see, after the congestion, this tiny candle telling us that the market is at support, and it wants to go higher. So we take the chance, 183.83, and our target was 200. So somewhere in this zone. So when there is a upper resistance at 50-day moving average or 200-day moving average, so this is a resistance zone. So if the market reaches, because it failed here, you see here, it failed to cross. So if it failed previously, it can fail again. So what are the chances that it will not fail? Maybe fail, maybe go up, who knows? So 183 long, we close it at, I don't think this chart is correct. We close it, maybe we close at 192, we got in at 183, or maybe we close at 200. I think maybe half here and half in between. I think it's above 200 now. Anyway, so it's 23% gain on Burlington. This one is Caterpillar. So when Caterpillar is going up, you have to see what is happening. Technology stock may be coming down. Maybe the Caterpillar is going up. Maybe John Deere is also going up. Maybe CMI is going up. So the construction stocks are going up. So the way I look at it, I say, okay, after the 3 down days, it gapped up. So what are the chances that it's gapping up just very close to the 50-day moving average? Chances are the Caterpillar is going up. So we went long at 135 and look at what happened. So so this is a charting tool. I have a stock chart right now in front of, and I use TradeStation. So if your skills are good, you can use any chart and use it. So it's like if you're an artist, and somebody wants to draw ask you to draw the picture, and you're sitting in a restaurant, you can draw the picture on the napkin. So that's the way the trading should be. So you have to reach that level. So draw the picture on the napkin. So this was the entry at 135, and then we exited. So this was a huge move. So it's fine. It cleared some resistance. You see, it cleared some resistance. So it's better to hold. But then next day when it gapped up, it put on a little candle. So when it put on little candles, I'm very picky about these tiny candles. If I'm long and then the market gaps up back to back, so there are two gaps here, actually three gaps. So one gap here, another gap here, two, and then another three. So if there are three gaps occurring one after the other, uh, that becomes like dangerous. So after three gaps, you have to be on the guard to take your profit. Now, traders forget. They look at the recent chart, and then they don't forget what happened. Like they don't learn from the history. They don't learn from our forefathers. So it's like this. So if you see this candle, you go all the way left, keep going, keep going. So this area is clean, clean, clean. And here it is. All the battles happen here at 144 level. So you see that. So when it happened in January of 2020 and late December. So all these guys, they bought. All these guys, they bought. When they see this, do you think they are happy? They're not happy to see that they are break even, that they are break even right now after so much downfall up. So when it crashed, all these buyers, they saw this downfall all the way here to 90 level. So from 144, they saw it to 90 level, and then it came back up to 127, and then it fell. Again, 100. Now it's bouncing. 140 didn't reach 144. I'm not going to close at 140. I bought it at 144. I'm going to close at 144. Then again drop. Then again it took off, and then it hit 144. So all the break-even guys want to sell. So when all the break-even guys want to sell, what will happen? The supply will come in. So this is your supply zone. So you have to extend it. So when you extend this area, 140 and 144 is the supply zone. So if you're long, and especially if you have option, and if you have 81% gain, you close the trade because you worry you can get in later. But what if it falls back to 135? I think it fell down. Caterpillar fell down. So we exited just by applying this logic, the thought process. So when you're trading, you have to adopt certain thought process, and what are the chances. So my risk. So if I'm trading here, if I went long and I say, okay, my risk is 127. So this is my risk, right? And this is my gain. So this is my risk and this is my gain. So when I'm here, so I'm seeing the gain, and if I don't stop trading or close this position, then what happened? My risk became so big. My risk became from 144 to 127, unless I'm very, very professional, that I will close it at one break of 140. What if it gaps down? What if it gaps down? Then all the profit I give back. So 81% gain today is better than 100% 2 weeks later, or maybe not. CRM. So there are many ways to skin the cat. Earnings. So this was our earning trade. We exited before earning. Today CRM went to the moon, but we exited. So we exited around 212. So we went long on CRM around 196 because the earning was coming up. So earning run up from 50-day moving average. We went long and we closed at 208 because of this resistance. So we closed it. We went long from here and we closed it. And today was the earning. So anything can happen. If I have a gain of 66%, I can hold one or two contracts. This 66% gain on earning, it can go to 130%, or it can be zero. And once it becomes 0, then it's very hard to come back to 66%. So then it's like demoralizing. It's just kicking yourself. So you can keep one contract, or maybe whatever is your profit, you can keep it for the earning surprise and see what happens, or close everything. So I close officially, we close at 66% gain right here because of the double top. We said, okay, we close. DFS, so this was also earning trade. So this was put on after the earning. So you don't have to really, you can trade earning, but see what's happening after the earning. So after the earning, if you see the reaction in the stock, which is negative, despite the stock having a positive earning, and you say, okay, why is going down? It should be going up. So you can go long after the earning. So for example, CRM. So today CRM went up. So tomorrow I'm not going to buy calls, but definitely I'll keep it in my radar. So it's not going away from my watch list. So I'll just I'll look for the opportunity in CRM and see the reversal and go long. So that's what I will do for CRM. So similarly for DFS, when the DFS came, I think it did this. We went long at 51 and then we closed at 54. So it took a while. So chop, then we close it at 28% gain. So after, when the chop happens and we hold for, then the time decay kicks in. Even though the stock moves in our favor, the percentage gain goes down. So let's close it and go with something else. Here's DHI. So DHI, this is what happened. So this is the logic and the thought process. So this is a white candle, you see, and then you see the counter attack. So the counter attack candle is what called bearish engulfing. So there's a lot of things goes on in the bearish engulfing. When the bearish engulfing occurs, then you have to go through your thought process and your techniques and what you're going to do with it. So we went long on this entry at 66.87 in DHI, and we closed at 68. It went up further. It went up further than 68, but we locked at 32% gain. So it depends what the market was doing, what other opportunities we have, how many open positions we have. So there are a lot of things goes on in deciding whether to close or not to close or keep it, and how the stock is expected to move. If it's Apple, we're going to keep it, or Facebook. Otherwise, we close. This is the Disney earning trade. I think this was earning trade at 117. So what were the chances of Disney going down and or to go up? So we said no, it's chances are it's going to go up. So we went long, and then we closed on the earning day. It's up further, but we had 86% gain next day, and it crossed the 200-day moving average. So so this was near the close, 129. So what are the chances of Disney if we have 86% gain next day? Right at the earning. So we bought today near market close, and next day we're selling. What are the chances of Disney to go up or to go down? And we don't see this 86% gain. We only see 30%. So it will hurt. So we took the profit at 86%. Here's a Dish. So Dish had a support at 50-day and 200-day moving average. So it crossed. Ideally, the entry came one day earlier, but I missed it. So entry came one day earlier when I saw the white candle, but I missed it. So even though if you miss it, and if you have a potential, you can, and if you have money in your account, you can go long. You can buy a few shares. So we bought the options at 33, 70, 78, and then the target was somewhere here, 38. So the target is easy. The target is easy to calculate when the stock is in the charted territory. It's easy. Anybody can figure it out, the chart, the target. It takes a skill to figure it out, the target, when the stock is trading in uncharted territory, like Facebook or Apple. That's where if you can figure out the exact target, that's where you say, okay, I'm professional. I know how I can calculate the target in uncharted territory. I'm not just, guessing. So 33.78. So the Dish fell from 38. So we know, okay, this is somewhere we will sell. So you see, magic happened. But this magic happened after 2 weeks, but it did happen. So when the market is going up and down, I receive email. Are we stopped out or this, that? Are we holding this? Should we get out? So I tell them hold, because technically, if you look at this chart, technically it's not giving you exit at all. So even though the option may be giving you exit, so people get out at 50%, 60% in the option. They say, oh, I subscribe to certain newsletter, and the guy says that, okay, if the option hit 50%, you are out, because the 50% option will take 100% gain to, to loss, to cover, to hunt. So, but you're trading options. Nobody's telling you to trade options. You are actually trading stocks, and on top of that, you're trading the market. So what the market condition is. So when you combine the market and you're trading a stock, you're not looking at the chart of the option. So your decision should be based on the stock and the market, what the market is doing. Your decision is not based on certain percentage of the option. That's my thinking and my belief. So I kept telling hold, because this was we got trapped. Like I teach my daughter, she's 6 years old. She sometimes sit and I say, Daddy. So she sees something and she said, Daddy, are you trapped? So yes, we were in a trap, but the trap was there. 200-day moving average is there, and then it popped up. So when it popped up, 25% gain looked really good. So we exited it, and the reason we exited, it's clear cut here, and then it's hitting this previous double top from where it fell 2 times. So if it fell 2 times, and then if I look back on the left side, so I have to go all the way to the left side, and I see here, this was an attempt here also. So there's a gap here, and this attempt failed. So this attempt failed here. So the sellers are here, and it's giving us a chance of 25% gain. So the idea, our strategy should be that we should get out of this and take 25% gain after waiting for 2 weeks. Here is our FB call. So FB call, we traded FB 2 times. So one is the I think this is a 253 trade is after the earning. Yeah, after the earning. So we were long before the earning, and we sold at the earning with a gapped up big profit. So once you sell after the earning, let's say you are in CRM and you sell tomorrow, then you need to look at the re-entry at the better price. Better price than, ideally better price than where you bought, where you sold. So if it's the same month in the same strike, ideally you will be buying a newer strike and a newer month, so you're rolling over. Or tomorrow you can take the profit in CRM and reinvest with the higher strike and a new month, or you can create a spread. You can sell the shorter strike above. So you can do many things tomorrow with CRM if you have CRM. So for FB, we went long before the earning gapped up, we sold. So on the gap, so big profit. So what was the logic for FB trade? So okay, so I do advertisement on FB. I know how much I spend money on FB, how much FB is making for me from this little guy. So FB is making billions from ads. A lot of you maybe from my Facebook ad. So I know that. So there are companies who are boycotting and all that. So it's just a little dent. So Facebook is going up. They're making too much money, and they have so many projects and all that. So we all know that. So the common sense, what it says, the common sense, will they beat the earning or they will fall on earning? So I take my chances on going long. So we went long, and then next day we sold. So after we sold, then what happens? It can give a re-entry for higher strike in a new month, something like that. So if we had, let's say we bought maybe 240 strike, I forgot which strike, 240 strike, and we sold it. Now, if it's trading at 250, 253, and it's giving us a re-entry with this candle, we go long and then ride it upward. So once the stock crosses 250, it may go to 300, or it may go to 280 or 275, something over there. 275, 280, maybe 300, so it can keep going. So don't miss that chance. So we went long here and we sold it. Okay, so this is another trade. So we sold FB today also. So maybe that was a third trade. So I forget. We trade FB and Apple and Baba Baidu so often. So this we sold at 277 on 7th of August. So we made 25% gain. So we went long here and then we enter again and we closed it today at 281, between 281 and 282. So we sold FB again at 281, 282. Here's GS calls. So when the financials are going down, they go down altogether. When the financials are going up, they go up together. So these days the financials are look like they have started a new life. They start to move up again. So this was our GS entry right there, 204. And the reason was, if you see that you have to be street smart in trading, you have to put 2 plus 2 together. So a lot of traders, they are bogged down. They go read level 2. They go in the chat room and watch the guru doing it, and the guru is doing it pump and dump. He goes in the other computer, he buys before he tells you to buy, and then he tells you to buy this penny stock, and it goes up because there are 5,000 traders. They're following that guru, and the guru sells on the side. He liquidates his position because he told 5,000 people. But you don't have to do that. You don't have to be trapped like that. This is a common sense trading right there. When the market gaps up to 50-day moving average, 200-day, what is your support? Worst come worst, if it breaks this 200 level, 199, you're out. But what if the market is going up? What if other financials are moving at the same day? So if you see GS is going up, you look at JPM, you look at Citibank, you look at Discover, you look at American Express, Visa, MasterCard, maybe look at PayPal, maybe look at Square. So you have, you come up with your strategy that, okay, if I'm going long in GS, I'll look at Citibank, JPM, Visa, MasterCard, American Express, PayPal, Square, and figure it out what is happening. Is it better to trade Square or PayPal, or is it better to trade GS or JPM? Which one is telling me clear cut that wants to go up, and they're all going up together? So GS went 204, and this is what happened. 209 we sold. So 5 point gains in GS. Maybe our strike was 210. So we made 27%, which is okay. So we made 27%. Who knows what happened that day? Maybe the financials were coming down and the market was coming down on 10th of August. So I don't know. I have to look back for the reason why I exited at 209 when I entered at 204. But 5 point gain. So if you bought 1,000 shares, like I have members, they buy shares. They are millionaires. They buy shares. So if you buy 1,000 shares, you made 5,000 profit, or you sold naked put. So maybe you sold put out of the money puts expiring in 2 weeks. So 10th of August expiring in 2 weeks on 21st of August. Maybe you collected $400 per contract in selling the puts and bought 10 contracts. So that $4,000 came in your pocket, and the puts expired. So whatever the strategy, maybe you put the spread. So I don't know. I'm giving you the trade, and then you come up with the strategy. But I'm telling you to buy calls or buy puts or buy the spread. Here's JPM. So here's another one, JPM. So JPM, if you see this pullback occurred and then the reversal happened. So what are the chances for JPM to come down or come or go up after this putting on the this white candle? So I would say, okay, I go long, and this is what we went long on the earning. So on the next day after the earning. So I believe this was the earning reaction a little bit, and then the reversal. So we went long at 99.88, and then boom, 106. So we sold. It took. It's actually not a boom, because this is what happened. It's choppy. So if you are asking me, if we bought 90 at 99 and it goes to 95. So if you look at the chart and if you say, are we stopped out? I'll say no, hold, because this is what I'm seeing. It's just a pullback, and then the gap occurs. So 2 gaps back to back, it's time to ring the register. And another thing, so don't look at the darkness. Don't be trading in the darkness. So you have to look this. If you look on the left side, this gap got filled here again. So the gap got filled here. This gap occurred, and this gap filled, and it failed. There was a resistance. So there was a resistance. So you see the gap. Here's the gap. This filled here, almost filled here, then filled here. Then there's another gap here. So there's a gap, big gap, and then it tried to fill, it filled almost to the penny, and then it fell. So it fell down, and when it fell down, then there's a two gap back to back, and again it filled. So what are the chances? This time it looks like it's going to go up because it filled and it stayed above the gap. You see this gap here, and it filled, but there is no written rule that it will fill the gap and it will not come down. And two back-to-back gaps and 2 weeks it took. So we rather take 45% gain and move to something else. So in option trading, the compounding effect and things like that makes sense. Also, if you understand where to add more to the position. So if you start like traders, they start with a bang, bam, I bought 10 contracts. Doesn't matter if it's an Amazon contract or if it's a Macy trading at $6-7. They're buying 10 contracts for Macy and they're buying 10 contracts for Amazon. So no clue that they are creating disaster. So if you trade like that, you will not make money, whoever send you the trades, it doesn't matter what. So and you jump fully. Even if you have money, you jump fully and put it all in one trade or two trade or three trade, and that's it. You're sitting there for home run. So ideally, you initiate a position with a little bit, and then you see it. It can do like this, and then when you see the break, so this one break came, you add a little more, then you added more on the gap, and then finally you close. So you have to manage your trades. If you know how to manage, you make a lot of money. Your gain may be more than 45%. This is official gain based on the buy price and the sell price. Some traders may have 100% gain, 150% gain because they accumulated here. They nibble little by little, they nibble at the lower price. So their gain may be 100%. That's why some of my members are just killing it. LBS. So when we trade LBS, we see LBS at the support. So LBS, if I'm trading LBS, I'll see MGM, I'll see WIN, and I'll say some news, positive news coming for the economy to open, and there's a vaccination news or this, that, whatever is it. There's some news which is popping this LBS at 44. And look what happened. Back to back, two gaps. So when the back-to-back two gaps happen, I take profit, especially when I see this kind of reversal candle happening. So I'll be quick to take the profit, which is 77%, not bad. Here's QQQ. So we trade DIA, QQQ, SPY, etc. in our index trade. We always come out as a winner because for QQQ, to trade QQQ, traders just if you were trading QQQ in isolation, maybe you have some strategy, you're making money, but to trade QQQ, we take help from a lot of other things. So the lot goes on behind the scene to trade QQQ. So there's one way of it looks like okay, QQQ is going up. Let's go along 271. Behind it, a lot of analysis went on, and then we closed at 281. So 3 days of pullback and then took off. Close at 281. So now we are looking for entry for a pullback. So if pullback occurs, and I'm expecting market NASDAQ to go higher, even higher and higher. So QQQ will go on. So I'm just looking for the pullback in QQQ and go long. So this is our index option service. Now here's TDOC. If you look at TDOC, this looks like a people say, okay, TDOC, go long. So I send alert to go long in TDOC. It had a bad news. It's just a waterfall decline. You see this big bar waterfall decline. There's nothing looks like long right here. I mean, how can you go long on this big bar down? So I send alert, and the magic happened. So the magic happened because of other technical skills. I showed you just the speed line, but there are many others. So, and then you can look at the left side. So 192.93. If you look at this, this is. Do you see the support here? The market took off. Same here. So after this waterfall decline, it's bouncing back at the same support level. So we went long on TDOC, and we made a lot of money on TDOC because TDOC moved a lot. So we exited actually so we exited here 230. So you see some in between, some at 230. So from 193, the T-dog, next day it went down, but it didn't give us the exit signal. You see that it just touched the low and set in this zone and then took off. After that, it just went crazy, like really crazy, and it hit when it hit 230. So it was approaching the price level from where the waterfall decline happened, non-stop. It's bought. So this big candle is saying, okay, watch out. We can go long again, but 237, so 111% gain, a big gain. If you bought shares at 193, you sold at 230, so it's 37 point profit. So if you're a big boy, 1,000 shares, 37 points is 37,000 shares profit. So I do have some, they do like that. They trade, they sell the puts. Or so if you receive alert at 193, and if you see the premium at 180, and you say, okay, I will sell the puts at 180, strike. So because you are willing to take those shares at 180 minus your cost, your premium you're collecting. So your cost is going down below 180. So if you are collecting $4, $5 premium, so actually your cost is 175. So you're willing to take shares at 180, your cost become 175 for T-Dog, and if it gets assigned to you, and then you start selling the calls against it, out of the money calls, collect your premium, you keep lowering your cost, and then there's a time come where you sell at profit. So that's what one of my client does. He has $1 million account. This year so far, he has collected 900,000 in premium. That was 2 weeks ago. I don't know what John did in this last 2 weeks, maybe another 40, 50,000 in premium. So he collects premium. So 237, the 230 we sold at 111% gain. Here's Toll Brother. So when Toll Brother is going up, look at the other builders. So builders are going up, construction companies are going up like Caterpillar and CMI and John Deere. So if these are going up and you see the builders are going up. So what? And the Home Depot is going up, and the NG List and Lowe's. So you making up your mind, you putting 2 plus 2 together, and you saying, okay, I'm going long with Toll. So we went long at Toll at 39, and we sold at 43. So we sold at 38%. Then I saw the pullback and wanted to enter, but did not. Missed it again. Another trade. So now it's at 45. So I'm regretting not taking a second trade on Toll Brother. So I'm just looking at pullback. So we have swing option services on the website. Here are the features. So I have a 500 basket. The way I do is I have a basket of 500 stock. So I call it like my big basket of database, a database of stock 500, but then I divide it into two pieces. One has 170 stocks and another one is 230 or 330. So 330s are also divided into two. So I have three baskets of 500 stocks. So out of 500, I have 170 stocks where all these big Momo stocks reside, all those you saw and they move. So I look for my trade from 170 stocks, and 8 to 10. So this swing option service, which is listed on the website, is there are 8 to 10 trades are sent per week. So it's better to trade less than to trade few and hold on for a higher gain, but sometimes take quick profit also. So it depends what the stock is doing. The objective is the average percentage gain is 47 to 50%. So that's average gain if you take the average of the last 200, 300 trades. But some trades have gone above 100%, like Sohu, 325%, and others. So we have triple digit winners, so it compensate. Exact buy price is provided. So when I'm sending you alert, I'm saying you exactly what price you need to buy, no more, no less. If you miss it, you can wait and get the better price, maybe pay 5, 10, 20 cents extra, depending on the option price. So you get exact buy price from my server, which is dedicated just server for sending the trade alert, the technology, etc. Within a second, you get the alert. We also send alert through SMS. We are opening a Telegram channel. So you will be enrolled in Telegram. We are coming up with the app. So I'm working on it. So you will have app, you can download and get all the notifications. So when the app is ready, I will let you know how to download, and Telegram channel. But right now, email and SMS. We do provide advanced sell targets. So we provide 3 targets. I call it green, yellow, and red. I used to provide these 3, then I stopped. Now I'm providing it again. So green, yellow, and red. So green target means that there is a 95% probability that the trade will hit this target. So the green target is a closer target where you make 20-25% gain. Sometimes 30-35, and the yellow target is where you make 40-45% gain, and it has a 85% probability. And then there is a red target which has a 70% probability. So when the targets are coming closer, I'm revising it also, the green, yellow, and red. So I'm revising it and sending you also that when I revise, the red target become yellow and the yellow become green, and then I give you a new red target so you can maximize your gain. So I'm always looking for members to maximize their gains. I'm not looking to show how many winners I have in my list. When somebody asks me for the track record, people ask, okay, what is your track record? How many wins you have? How many losers you have? So actually, they don't know what they are asking for. They're looking for, they are asking the wrong question. So I can have a great track record of 15% gain or 20% gain and 100% loser. Rather, I have the balance, the percentage gains and percentage. So I'm balancing it, I'm juggling around, I'm revising the target, because when I see the target, I revise it. So I revise green, yellow, and red target so you can take action, because some members have more than one contracts. They have 10 contracts. If they have 10, they can sell 3 at green, 3 at yellow, 4, 5 at red. Maybe they want to sell all at yellow because yellow is the main target. So it's up to the person's expertise also. Some are professionals, some are learning. So some are with me for 10 years, some are just joined yesterday, some are just joining right now. So all trade alerts are sent via email and SMS. Trade, ideally, the swing trades are supposed to last from 1 to 7 days. So, but there are some trades, they do go above 10 days, some go over 20 days. So I have a history that even if the trade goes beyond 30 days, they come out as a winner. And some don't come out as a winner. So some we do lose on it. So we do have a loser. We do have losers. It's not that we are. If I have 100% win rate, I'll become a billionaire overnight. I just keep compounding my money. So for this swing option service, ideally you need to, the bigger is your portfolio size, the more game room you have, the more game you can play, because this is a game. So think about stock trading is a game designed by big boys to take the money from the young little boys. So they take from the little boys. So they come up with the Facebook got created out of thin air, and billions of dollars got transferred to Mark Zuckerberg. It's just in the sky, virtual. You see nothing. It's just a Facebook, but billions of dollars. So this is a game. This is a game for those who have more money in the account. The bigger the money, the bigger they have a chance of success. So if you have a $5,000 or $2,000, it's not. This game is not for you, unless you join swing the index option service, and then I keep sending you the winners after winners in index option. So ideally you need 15,000, but starting is a 15,000 because we have 10 trades, 12 trades, you are open, so you need to juggle around. We send you 75 pages trading system guidebook. So I explained to you in that ebook how I do it. It's not everything is included, but the method, so what you are supposed to do, how do you supposed to act, what is expected. And then I teach you for free, like this right now. Today I taught you for free. I'm spending like what, 1.5 hours. And then constant education through emails, tidbits, etc. I provide. And then if you are in my database, you are getting free educational emails anyway. But if you're a paid member, then I send out the tidbits here. There's some words of wisdom, what I learn and I'm learning. So this service, swing option service, is designed for active traders. So if you have a cell phone, so sometimes people, it's okay. You can make money from cell phones, but ideally you need to be have a desktop. So not like a Robinhood trader where you sign up, $2,000, download the Robinhood app, and trying to make become a millionaire. So it's not like that. You need to be so if you are working from home, if you have access to the computer from work, you can monitor your position. You can read your email on a cell phone, and then you say, okay, it's time to act. You open your platform and you act. So this trading is like that. So yeah, so green, yellow, and red are the three targets. Do you have a prorated cancellation policy? So no prorated cancellation policy. So we don't prorate. You can cancel anytime. So you just cancel anytime and you will not be billed. So we don't bill you anyway. So if you have SMS, please send to admin Genie with your phone number and your phone carrier company. So please do that. And let's see what else I have. There are more questions. So you want to, James, you want to see my monthly profit and loss? Is that what you're saying? I send you my monthly profit statement. I download from my broker and say, okay, Mr. James, here is my monthly profit. Are you happy to see my monthly profit? And then are you willing to pay me $77, please, James? So no, James, I don't do that. I care less. Next question, quick question. A lot of these stocks are closely tied to index, SPA, many times index down because it has to bring down the stock to how to get the confidence it reaches the expected target. Yeah, so if you're trading Nasdaq related stocks, and if the Nasdaq goes down, those stocks will go down. So you have to. The first step in successful trading is understanding the market. So if you don't understand the market, the first step is that's where you fail. So understanding the market, we do have a market trend service, so which is like $27. It took me 10 years to I was doing it manually, and then I computerized it. It still takes time for me to do the analysis, and I provide that analysis for $27. So you can sign up on my website for monthly daily market report. It's just $27. It's like $1 per day. It tells you the strength of the market. It tells you the volatility is very correct. It's like 100% correct. It gives you the major trend. So we are long since April 17 when the March 23rd low was made. We caught it, and starting so February when the market started crashing, we were short. We did a lot of puts trade, made a lot of money triple digit, because in the puts trade you make triple digit gain fast. Volatility is high, everything is going crazy. You can throw the dart and you make money in that kind of market, provided you exit also, because bearish market is volatile market. So you have to know your limits. So during that period, we made a lot of money through puts. And then what happened? The money we lose or the traders lose is when the transition is taking place. When the market is making a transition, that's where you lose money, because the trader gets caught in the transition and they don't realize the transition is happening, and they stick to their portfolio and they lose. So if you can figure it out the day the market has transition, and if you close all your long position, let's say, and you go short or stay on the sideline, and then when the short signal occurs, then you take short. People don't do that. They just stick to it, and then they go through 360-degree cycle. So 23rd of March, when the low was made, and then the market was so volatile, if you remember. So we had some put position. So we did lose on those 3, 4, or whatever the put position was, because then I figured I knew my minor trend gave me a signal long. So minor trend, so it's the minor trend which gives you the signals first, long or short. Then the major trend comes later. Major trend will come after 2 weeks, 3 weeks. By then you are killed. So as soon as the minor trend is giving you the signal, you have to do something. So the minor trend, and it was low, and the low was, so I figured it out that March 23rd is the low, and the minor trend gave us a long signal on March 24th. So I closed all the put position, and since then we are trading long, except 2 trades. I think we put short. One was a minor gain, and one was a GS put, in which we lost maybe 27%. Then we turned around and went long and made maybe more than what we lost in the put. So in this period, we are long. So the major signal long came on 17th of April. So if you are subscribed to the report, you will see 17th of April long, and in the CNBC and all that, the low will be tested. Is it going to test, or is it going to fall? Is it going to make a new low and the market is going here, there, all that nonsense. And we stick to the long. Since 17th of April, we are long. And so knowing where the market is going, where the market resistance are, I'm telling the market that the market will make a new high. So the S&P did made a 74, 34, 35, the target. Now I expect the market to go higher, 3,700 level. NASDAQ, I expect 12,500. So the market gives you a market detours. So market, when it's going up, and especially in an uncharted territory, nobody knows the target. So it's very hard. Market doesn't, nobody knows where the target is. So that's where your skill comes in to figure it out. If the market has gone up and it says pullback, the pullback is over. The pullback was at the support. Now it's bouncing, it's going to a new level. Where is the new level? So the new level is 12,500. So knowing the 12,500 is the NASDAQ target, and it could be 15,000. So I will trade based on the market. And I trade futures, NASDAQ futures, so I take advantage of this. So I trade futures, and I know 12,500 is the target for NASDAQ. So I trade futures and make money in the NASDAQ futures. So there's a skill in your success. You need to know about the market. If you don't know the market, then you're trading blindly. So the way so it says, any sign the market will turn red soon? So no, I have no idea when the market will turn red soon. Thank you. So there's another thing I heard. So people send me email. I heard that the market will crash soon. I read that the market will crash soon. I read about this indicator is flashing red signal, the market will crash soon. So all this I heard, I read this indicator. So if you rely on that indicator, if you heard from somewhere, from the angel came and whispered in your ear, the market will go south. So if you believe in that angel, you go. Otherwise, all these newsletter guys, they are there to scare us. They make money. First, they tell you that the market is going to hell, and then so then they will say, okay, you want to find out when and how deep is the hell? So you say yes, and then they will say, okay, pay me this much. So then you pay them, and then you read their hell report, which is full of garbage. So they're just making money from selling you those newsletters. So I don't do that. I have my own. So I don't trust anyone. I trust myself. So I believe in my analysis, and I trust. So it's like me, with me, if you're with me, if I'm dying, you will die. If I'm going to heaven, you go with me to heaven. So it's like that. So I don't know about the market turning red. So you subscribe to the newsletter. So what happened? So we have a market strength. So the market strength is, we rate the market strength from very strong, and then there's a neutral zone, and then a weak, very weak. So when the market is bearish, it goes into weak and very weak mode. So the more weak it is, the more good it is for trading bearish position. And when it's neutral, so when it's neutral, then you have to, the strength is neutral, then you have to decide, okay, it's neutral, it needs to come on the green side, on the strong side strength. Otherwise, the market can go on the weak side. So then you start looking at your trend analysis, the change in trend. So that's where the market money is. When you spot the change in the trend, that's where you say, okay, enough. I'm going to close my position long, and I'm going cash, and then I will start making money through the shorts. So that's where the it's like in a movie Heat. If you watch movie Heat, in that movie, Robert De Niro said to Val Kilmer. So I watched that movie many times. If you have not watch it. So Robert De Niro is telling to Val Kilmer, he's giving advice. Robert De Niro is senior to Val. So he's telling Val Kilmer that when you spot the heat, you need to be able to get out of the town in 30 seconds. So that's what Val Kilmer did. He spotted the heat, and he got out. Whereas Robert De Niro, he did one mistake at the end. He got into revenge. So revenge makes him die. So that's where we go in the market and we take revenge, and the market kills us, or we don't spot the heat and we stay longer, and the market just keeps us killing us until we are no longer able to fight. So the moment you spot the heat, you take that red pill like Neo did in Matrix, and you swallow that pill and you stay on the side and you say, "Thank God, I'm in cash. Now I'm ready to make some serious money in short." So so you have to be on the top of the game. So we do have a market analysis. You can join if you are interested in spread trading. We have a spread. We have a index option service. We don't have on the website. We don't have a naked put service, but I do provide naked put to just selected few traders. So I do have a naked put. So if you have a bigger account, if you are into collecting premiums, if you can, if you don't mind the stock, the quality stocks getting assigned to you, like Facebook, Apple, Baba, Baidu, all these, if you don't mind getting assigned and you want to collect the premium, so sell the premium 2 weeks, puts, sell the puts, and then you collect that premium. So I don't have that on the website. I have a 1-year coaching program. You can join. You have to send me email. Please don't ask what is the cost and what is the curriculum. I don't tell in email, so we have to talk. I do have a 6-day coaching program for duplicating success. So duplicating success program is about how the top traders think in the market, what they do before they come in the market. They don't just turn on the computer and they start trading and making money. They come up with they have certain rituals, or by rituals mean they have certain things they do before the market opens. They just don't wake up, hurry, and then open the computer and the coffee is, in the coffee pot, and then okay, what I'm supposed to trade today, let's go. So they don't do that. They have certain steps, so I teach those steps. So I do that, and then during the market, so when the market is open, they have a certain process to go through. So are you following those process like the big boys do, the top traders? So I teach you that. And then when the market is closed, what are you doing after the market is closed? You just, when the market is closed, and you close the computers, and then you go to the beach or do something or go to the work. So what do you do? So there are certain steps you need to take. So if you're interested in that 6 session coaching program, send me the email and I'll send you the PayPal link. It's not on the website. My new website is coming up and it will list those uh, coaching. And I have a new domain, tradegenie.com. So you can go to tradegenie.com instead of my TradeGenie. And the coaching will be listed there. So you can go there, and the new service is coming up. So I've been talking and then no more questions, I think. So I'll say goodbye to you guys and I'll see you in 2 weeks. Or if you're not member yet, join. You are missing out. Thank you. Bye.